Hey, what's up, AP Macro students? It's Mr. White here with some notes for you about the money market. So go ahead and get out your notebook and follow along as I go over some important information about this really critical aspect of Unit 4 and monetary policy. Today we're going to talk about the graph that is really your go-to graph for monetary policy. You got to know it for the AP exam, and you definitely need to know it for the unit test coming up soon. So please let me know if you have any questions. You can email me, you can send me a message through Remind or through Google Classroom. But let's go ahead and talk about the money market. All right, guys, so this is it. This is the money market model or the money market graph, which is basically just a graph that shows us the quantity of money that's in circulation available to be spent. We're talking mostly about physical cash money currency and demand deposits, meaning checking accounts. Okay, so what we got here, we got the real interest rate over on the y-axis, got the quantity of money down here along the x-axis. MD is money demand and MS is money supply. So we'll talk about the significance of all these different things coming up soon, but it's just important that you know what they mean before we go any further. Okay, so this is really the go-to graph that you're going to use to model the effects of monetary policy. So whether you're on the AP exam or the unit exam or any of the worksheets we do, if you want to try to find out what's going to happen with things like interest rates, if the Fed does a monetary policy action, this is what you could sketch out on your notebook paper real quick, and this will give you the right answer 9 out of 10 times. So it shows us the side effects of monetary policy. So whenever you hear a monetary policy action, your brain should revert back to this graph. Now, the main way the Fed changes the money supply, you may remember, is through open market operations. Open market operations means the Fed can buy or sell government bonds. When the Fed buys bonds, remember that it takes away those illiquid assets from banks, it gives them cash money. Those banks will lend out that cash money, and so it makes the money supply bigger. Buy equals big money supply. Hopefully you still remember that. If the Fed sells bonds to banks, they take away cash money from the banks in exchange for these illiquid bonds. The banks then have less money to lend out. When the banks lend out less money, the money supply gets smaller. When the Fed sells, it equals a smaller money supply. So the way that would look on the graph, if the Fed buys bonds, we're going to see a rightward shift of our money supply curve because the quantity of money is going to go up. And when the quantity of money goes up, the real interest rate goes down. If the Fed does the opposite, if the Fed was going to sell bonds, right? Sell equals small. So when the Fed sells bonds, quantity of money is going to go down and the real interest rate is going to go up because what's going to happen is our money supply curve is going to shift around. And so we're going to be looking at how that works. That's really the main thing you got to learn here. So the reason why our money supply curve is perfectly inelastic is because money supply is under the exclusive control of the Federal Reserve. When I say that it's perfectly inelastic, all I really mean is that regardless of whatever happens over here on our y-axis, the x-axis doesn't change. It shows that money supply is not related in any way to the real interest rate other than how it creates the equilibrium between money demand and money supply. And the equilibrium between money demand and money supply is what determines the nominal interest rates in the economy. In other words, the interest rate not adjusted for inflation. Okay, so that's a lot to take in. So if you need to, you can watch this part of the video again. But just try to really understand that essentially interest rates just depend on how much money is being supplied and how much money is being demanded at any given time in the economy. So let's first talk about money demand, okay? Because to really understand this, we got to understand money supply and money demand. It may sound pretty straightforward because we learned about regular old supply and demand, and you might think, okay, well, money is easy to understand. Everybody wants it. Everybody needs it. But it's not so straightforward. But let's just go ahead and think through these things logically, and I think it'll all make sense, okay? The first thing we need to think about when we think about money demand is back to the old concept of trade-offs and opportunity cost. Right? When you get some cash money in your hand, you face a trade-off related to the decision about how much of that cash money you should hold on to, physically hold on to, right? So like, let's say, for example, if you got 5 $20 bills from your relatives at a graduation party, right? You've got 5 $20 bills, physical cash. How much of that do you want to keep in your pocket? Well, here's the thing. Keeping cash in your pocket provides convenience, right? Because it's the most liquid asset you could possibly have. If you've got five $20 bills in your pocket, there's really nothing you can't buy except for maybe like online stuff, but then I guess you could just put it in your checking account and you can buy it right now, right? But if you took that money, some of it or all of it, and put it into an investment that earns interest, like let's say if you put it into a savings account, or maybe you just decided to go buy a $100 government savings bond or something like that, what you're going to do is you're going to lock up your money in a way that doesn't allow you to use it. It takes away that liquidity. But you're going to start earning money from your money. That's one thing we're going to talk about later, is that money makes money, and money that money makes more money. That's a Ben Franklin quote there. But anyways, guys, so essentially you face a trade-off between earning free money with your money or having the convenience and liquidity of being able to use your money right now. Okay? So when deciding on whether or not you should hold that cash in your pocket or in your checking account where you can have easy, quick access to it, right? You incur opportunity costs, right? If you put it in your checking account, you're going to lose out on the ability to have interest, or if you have it in cash in your pocket, you're going to lose out on the ability to earn interest from that money, but you're going to have the convenience of liquidity, right? So basically, when we talk about the opportunity cost of holding on to cash, the most important thing that's going to really influence your decision is really the interest rates. If interest rates are currently really high, like let's say, for example, if there's a 10% interest rate on a simple savings account, which I hate to break it to you guys, but that's probably never ever going to happen. Simple savings accounts usually pay less than 1% interest. But let's say for some crazy reason, your bank offers you a simple savings account where you can earn 10% compounding interest every year. Holy crap, you should take that, right? As a matter of fact, I would take the whole 100 bucks, put it in that account. What you would see is that in just a few years, you could double the amount of money that you have, and you wouldn't have to do a thing. So that would mean that if you chose not to take advantage of that savings account, if you did not take that 10% interest savings account, you are incurring a huge opportunity cost, meaning that there's like free money you could have had, and you're sacrificing it for the little bit of liquidity you would get from having $100 cash in your pocket. Now, on the other hand, if interest rates are super duper low, like for example, if your bank is like, yeah, we'll give you a 0.25% interest on your savings account. So that means not even 1% interest, we're talking like 0.25% interest. Well, whoop-de-doo, that means that after a year, you would have a whole whopping 25 cents interest in your savings account. I think in that case, it would probably be more of a hassle to go put the money in the bank in the first place. You'd probably be better off just keeping the cash money in your pocket and just using it to buy stuff whenever you need stuff, right? There's not a huge opportunity cost of keeping it in cash. So the opportunity cost of holding cash means that if interest rates are high, the opportunity cost of holding cash is high, right? If interest rates are low, the opportunity cost of holding cash is also low. Hopefully that makes sense. Now, here's another example. We can get a little bit more complicated here for those of you who want to go into some more real life sort of stuff. Just a couple basic things you might know about. There's a kind of an account you can get at your bank. It's actually really easy to get. It's called a certificate of deposit, or a CD. It's a much higher interest savings account, but you're sacrificing liquidity because they're non-liquid, meaning that you got to commit your money for a whole month, or in some cases you could get them for longer than that, like 6 months or a year. But the nice thing is, if you get these 1 month CDs, you're going to get probably about double the amount of interest of what you'd get from another kind of account. So you're sacrificing the convenience of having access to your money, but you're earning a really high interest rate. Now, an interest-bearing demand deposit means a special kind of checking account where you can have access to your money and you also earn interest. But since you have access to your money, you don't get as much interest, right? So your money's more accessible than the CD because you can withdraw it whenever you want, like a checking account, but you're sacrificing a significant amount of interest for the convenience of being able to get at your money whenever you want it. And the last option is to just have physical cash in your pocket, right? If you have money in your pocket, you're sacrificing all the interest you could have earned by putting it in the bank, but you have the convenience of instant purchasing power, right? You've got a totally liquid asset in your pocket. So let's just take a look at some different rates. from June of 2007 and June of 2008. So just a 1 year difference here. You can see there's some pretty big differences in the rates. You can see that in June of 2007, we had a 1 month CD that was paying 5.3% compounding interest. That's pretty nice, right? So that means that you could get that certificate of deposit. You put in $100 at the end of it, you'd have $105.30. That's a pretty sweet deal. But of course, you can't touch the money for a month. Now, if you did an interest-bearing demand deposit, you put the $100 in there at the end of, let's say, a year, because this is same thing for the 1 month certificate of deposit. You'd have to reinvest that for a whole year, 1 month at a time. For a whole year, you'd get 5.3%. For the interest-bearing demand deposit, if you put your money in the bank, left it there for a whole year, you'd get 2.3% interest, which means that at the end of the year, you'd have $102.30. Not bad, but hey, it's a free $2.30. Go get you a soda or something like that. The last thing is, if you have physical currency in your pocket, how much do you earn? That's pretty easy math. It's zero. You don't earn any interest because you don't get any interest for having cash in your pocket, but you could spend it whenever you want without any problem. Now, when it comes to 1 year later, there were some changes in the economy. This is actually the beginning of the Great Recession. You can see the interest rates started to fall. A 1 month certificate of deposit now is only getting you 2.5% annually. So that means if you reinvest for a whole year, that 1 month certificate of deposit, you'd only get $2.50 on your $100. It's not quite as nice as the $5.30 you were getting a year earlier. The interest-bearing demand deposit at the same time fell almost in half to 1.24%. What that means is that now if you put your $100 in that special checking account, instead of having $2.30 at the end of the year, now you only have $1.24 at the end of the year. That's pretty lame. And same thing here, physical cash is still zero. So if you had physical cash in your pocket, really nothing changed for you between June of 2007 and June of 2008. You probably didn't even notice much of a difference. But if you're a person who is investing money, you certainly noticed a very big difference. And so this really drives home the idea that interest rates have a huge effect on the opportunity cost of holding cash, right? The opportunity cost of holding cash from June of 2007 to June of 2008 decreased significantly. Basically, what I'm saying here is that, in June of 2007, you might have wanted to keep your money in the bank, but by June of 2008, it really wasn't worth it anymore. The opportunity cost of having cash in your pocket was significantly lower. So let's take a look at this money demand curve. And now that we understand a little bit more about the opportunity cost of holding cash, we can understand this money demand curve. Because interest rates affect the opportunity cost of holding money, the quantity of money that people and businesses want to hold is negatively related to the interest rate, ceteris paribus, So in other words, when the interest rate is really, really high, like we can see here, okay, the quantity demanded of money is really, really low right here. But if the interest rate is really low down here, the quantity of money demanded is really high, like right here. Okay, so it's classic downward sloping demand curve. So if the interest rate increases, the opportunity cost of holding cash also increases, and so people won't hold as much cash. They won't demand as much physical cash, right, if the interest rate goes up. And short-term interest rates have a huge influence on people's decision about how much money they're going to want to keep in their pocket. That's what we mean by the opportunity cost of holding cash. Now, there are four main determinants when we're talking about money demand. In other words, like 4 things that could shift this money demand curve around. Okay, the first thing is a change in the aggregate price level, or the CPI. The second one is a change in real GDP, or how much stuff we're producing, right? The last 2 are changes in banking technology or credit markets, or changes in banking regulations and banking institutions. So the last 2 have to do with banks. So let's go through each one of these and try to understand how they could cause our money demand curve to shift. Now, the first one we're going to talk about is a change in the price level, or the CPI. And I think that probably you may remember when we talked about the CPI in the last unit. Maybe if not, go back and take a look at those notes. But when we talked about the CPI, we said that the CPI just basically measures how much the average family would have to spend to buy all the stuff they normally buy. So when the CPI goes up, the amount of money you need to buy stuff also goes up. So higher prices on average will cause the money demand curve to shift rightward, because people need more cash to purchase purchase the same goods and services. So as the overall price level in the economy rises, the overall amount of dollars you need to buy things also rises, right? Lower prices cause the money demand curve to shift the opposite way to the left because people don't need as much cash to purchase the goods and services that they need. So when things get cheaper, we don't need as much money in our pockets. This is all pretty logical, okay? So here's a great example. Just think about going out for a cheap date one night, right? A cheap date, I don't know, hopefully to you a cheap date means McDonald's and a movie. That's what it meant to me back in the day, but you know, times are changing. Who knows what you guys are doing these days. But anyway, so let's just say, you know, you got to gas up your car, go pick up your significant other, go to McDonald's, get a meal, and then go to the movie theater. And let's just say that you and your significant other are progressive and you guys don't believe in like somebody paying for the other person, so you're both going to pay for your own stuff. So we're just going to look at this from the perspective of buying one of these things. Now in 1970, let's say if you were going out back in the day of your grandparents, right? Americans didn't have to have as much cash money in their pockets like they do today because the aggregate price level back then was much lower than it is currently, right? The aggregate price level back then was 39.8. Today it's 252.77. So let's take a look at the difference here between buying a quarter pounder of cheese, 1 gallon of gas, and one movie ticket in 1970 compared to 2019, okay? So in 1970, that quarter pounder only cost 70 cents. So if you and your significant other went to McDonald's, you know, 2 quarter pounders, it's going to cost you like $1.50 with tax. Not too bad, right? 1 gallon of gas back in 1970, back in the day of your grandparents, was 36 cents. So even if you had a big gas guzzling car that, let's say, had a 20-gallon tank, you're only going to spend about $7 to fill up your gas guzzling car with 20 gallons of gas, okay? And then one movie ticket back then was about $1.50. So for 2 movie tickets, talking $3. So all in, you could basically go on a date, even if you were going to pay for your significant other, and you needed less than $20 in your pocket, right? Compare that to 2019. Well, in 2019, a quarter pounder with cheese, $4.50. We're talking just for the burger. A gallon of gas on average, let's say about $2.35. And then one movie ticket, $12. I'm not even going to do the math on that one. I'll let you guys handle the math on that one. But you can see there's a significant increase in the number of dollars you need in your pocket in 2019 to go out for a cheap date compared to how many dollars you needed in your pocket back in 1970. Okay, so as the price level has risen over the years, the demand for cash has also risen because we need more cash to buy the things that we want to buy. Now, change in real GDP. We know that real GDP measures the amount of stuff we produce over time, right? When real GDP rises, we're producing more stuff. When real GDP falls, we're producing less stuff. Okay, so if consumers and firms are demanding more output from the economy in the form of, you know, buying more stuff, then it stands to reason that all those people are going to need money to get that stuff, right? You know, if you want to demand more stuff at the grocery store, you need more cash. If businesses want to produce more stuff, they need more raw materials, they need more workers. Once again, they need more cash. So when real GDP increases because we're producing more stuff and demanding more output, then that means there's a rightward shift of the money demand curve. Okay, that makes sense. If real GDP is decreasing, on the other hand, if the amount of stuff we're producing is going down, if consumers are not purchasing as much, maybe because we're in a recession, well, then there's not as much demand for cash, and the money demand curve will shift to the left, right? People won't be buying as much. They're going to be saving a lot more to try to make it through the hard economic times. So pretty logical, pretty straightforward when it comes to changes in real GDP. Real GDP rises, money demand shifts right. Real GDP falls, money demand shifts left. Changes in banking technology also have a big impact on money demand. If banking technology increases, like if we have more ATMs and online banking and credit cards and mobile payment apps, think like Apple Pay or Samsung Pay or you know, Cash App, right? all that stuff tends to decrease the demand for physical cash. In other words, if you can have all your money in some sort of an online account, or if you have all your money in Bitcoin, you don't really have a need for a traditional banking account or for even like cash in your pocket. You can just pay for everything digitally. But what's even more interesting is that even when it comes to having things like ATMs, people demand less physical cash. You can put more money in your savings account because you can actually get the cash out of your savings account pretty easily from an ATM, or you can transfer money between accounts online really easily. And so as we get more different ways to manipulate our payments and have different types of technology for dealing with banking, we tend to have less demand for that old-fashioned analog paper cash. I mean, just think about it. How many of you have paper cash in your hand or in your pocket right now? Yeah, not many. And you see, it's because we have debit cards and all these other forms of payment. So more ATMs, more debit cards, those things tend to decrease our demand for physical cash because physical cash becomes less relevant, right? More banking technology tends to make our money demand curve shift to the left. So if you see any questions on tests or things like that about banking technology increasing, that's a leftward shift of money demand. If banking technology decreases for some reason, then we would have a rightward shift of money demand. A really interesting example is in Japan. Because of various laws they have, there are a lot of small businesses, and many of those small businesses don't want to deal with paying the fees associated with processing debit and credit transactions. And so in Japan, lots of businesses do not accept credit cards. You have to pay with cash. And so not surprisingly, in Japan, they have a much higher money demand. Their money demand curve is shifted further to the right than in the United States, where mobile payments and credit technology are widely accepted. Now, changes in institutions also can have a really big impact on money demand. For example, government regulations on banks. Back in the 1960s and 70s, commercial banks weren't allowed to offer interest on checking accounts. That was forbidden. It was a big time no-no. But Congress eliminated that restriction in the 80s, and that basically reduced the opportunity cost of holding cash in a checking account. Right? So in other words, instead of having your money in a savings account, which is relatively illiquid, you could put your money into a checking account, which is liquid, and also still earn interest. And so all of a sudden, people started demanding more money into these checking accounts. Remember that checking accounts or demand deposits are part of M1. So the demand for M1 cash started shifting to the right as people wanted to take advantage of these new kinds of checking accounts. So that's a good example of how changes in regulations or institutions could change money demand. So in general, right, fewer regulations shifts the money demand curve to the left, or sorry, to the right. More regulations shifts the money demand curve to the left. All right, so the money supply curve, let's talk about that real quick. It's kind of boring because it really only does two things. It only shifts left or right, and it only shifts left or right based on, monetary policy, okay? The reason why is because the supply of money is under the control of the Fed Open Market Committee, and it only changes when the Fed does things like buying and selling government bonds through open market operations that are carried out at the Federal Reserve of New York. They call it the open market desk for good reason, right? So this explains the perfectly inelastic slope of our money supply curve. So remember that whenever you're drawing this thing, you always draw money supply straight up and down, or as we say, perfectly inelastic. That just means that regardless of what happens with the interest rate here, it doesn't have any effect on the quantity of money that's being supplied. The quantity of money being supplied is under the control of the technocrats over at the Federal Reserve. Okay, so money supply curve, remember that it measures the M1 supply of money. And so this is a very important point. You got to just lock this in your brain. M1 means physical cash and demand deposits. And in case you forgot, demand deposit means checking account. So real quick, let's talk about what it means when the Fed does an expansionary monetary policy, okay? Expansionary monetary policy happens during the contraction phase of the business cycle. Sometimes people refer to this as an easy money policy. Easy money, expansionary, means the same thing. They just want to make it easy for everybody to get cash money. If everybody gets money, aggregate demand shifts to the right. That can correct problems with like unemployment, for example, during a recession. So the supply of money will increase when the Fed buys bonds. So if the Fed buys bonds, money supply will shift over to the right, right? And when money supply shifts to the right, that means the federal funds rate, the nominal interest rate, is going to decrease because the quantity of money increased. So we know that when interest rates are lower, it encourages more borrowing, not just by businesses, but also by consumers, right? People are going to buy a house or a car, businesses are going to expand, and it'll also decrease the opportunity cost of holding cash, right? Remember we said that when the interest rate is low, the opportunity cost of holding physical cash, either in your pocket or in a checking account, is low. And so we'll see people moving cash from their savings account to their checking account because they want to take advantage of the liquidity that they would get. Right? So that discourages savings and that sort of pumps up the economy. Remember, the whole point of an expansionary policy is to get people to spend more money as opposed to saving more money. We're not really worried about inflation. What we're trying to do is correct the problem of unemployment. So remember that an expansionary policy would be a rightward shift of our money supply curve because the quantity of money is going to get bigger. A contractionary monetary policy, on the other hand, is the exact opposite. If we're in the expansion phase of the business cycle, and let's say that there's a lot of inflation, the Fed is going to tighten up the money supply. We call that a tight money policy, right? They're going to make it harder for people to get money. And this is a contractionary policy. Remember, we're not trying to make the economy go into a contraction. Instead, all we're trying to do is just pump the brakes on the economy. We're trying to slow things down so that inflation can slow down, okay? So if we want to slow things down, we need to take money away from the economy, which means the Fed is going to sell bonds. When we sell, the money supply gets smaller. So what's that going to look like on the graph? Yeah, it's going to be a leftward shift of our money supply curve, right? The money supply is going to shift this way. And you can see that the equilibrium interest rate is going to change. As the quantity of money gets smaller, the real interest rate rises, or excuse me, the nominal interest rate rises. And that means that it's going to be more expensive to borrow money, right? Higher interest rates are going to discourage businesses from borrowing. It's going to discourage individuals from getting that new house or that new car because it's just going to make it more expensive to do those things. In case you forgot, remember, interest rates mean how much you have to pay to borrow money. It also will increase the opportunity cost of holding cash. If the interest rate is high, you would probably rather have that instead of being in a checking account, put that cash into a savings account that earns a lot of interest or into a certificate of deposit. Remember, those things are not liquid. You can't really use them to buy stuff, but they earn interest for you, so they make money out of your money. Not too bad, right? So the higher that nominal interest rate goes, the more savings we're going to encourage and the less spending we're going to have. Hopefully you remember, less spending equals less economic activity, and that keeps prices down. It cuts back on things like cost push inflation, and it also sort of just reduces that demand pull inflation that happens when everybody is spending too much money.